Hey Shane, how's it going?
It's going, man. How are you today, Kyle?
Doing well. I think still recovering from that big sell-off we had the other day. But getting my feet under me here. So how are things for you?
Pretty good. Staying busy. Today's been a bit of a frustrating trading day. I got stopped out of a few of my shorts on the opening rally, and then of course the market has dropped now I don't know, 1% or so from where I got stopped out of a few things. So I don't know, a little frustrated today, but I've got most of my core shorts still on and hanging in there. So yeah, it's a frustrating day, but I'm on the right side of the grass still, so that's good.
Perfect. And it's September 15th. No big events today, but we did get a CPI print. We'll talk about that, but let's just dive right into it here. So, first up, the SPY. So just zooming out here, looking at it. So here's the start of this year. I'll get my annotation device on here just so everybody can follow along. But, you know, here is the start of the year. We've been selling off. This right here, that has my attention. So we had that rally and it started looking like things were going to be real positive and we were all wrong. And then the bears jumped in and we had a 4% sell off the other day. And I think today we're consolidating a little from that because when you move 4% in the major indexes, it takes a minute to catch your breath, I'd say. But it does not look good. I think the Bears definitely have this one in control. What do you think?
Yeah, I mean that was Tuesday. CPI came out and everybody was expecting it to be a little bit lower than where it actually came in. But Tuesday ended up being the worst day so far yet for the markets during this bear market. So the S&P 500 was down over 4%. The NASDAQ 100 was down over 5%. And that's definitely an ugly situation. I mean, when you can get 8 months, ninth month of a bear market, and you finally get your worst day, seems to me that things are probably accelerating a bit to the downside. There's absolutely nothing to be bullish about right now. The sentiment isn't even really overly bearish, so you can't be a contrarian on that level. So like sometimes things get so bad and so many people are so bearish that you kind of want to buy that. But I don't think we're quite there yet in this situation. So I see basically no reasons to be bullish. Yeah, you're gonna get a couple of bounces. We saw a little bounce this morning, and it hasn't continued just to slide since the close on Tuesday. But I think the markets still have lower to go, and yeah, we'll probably get some bounces along the way, but that trend line break is pretty obvious. If you want to go to the next slide, we can see that trend line break a little bit better. Yeah, so there it is. I mean, um, we'll see if the market can rally back above that, but I think it's more likely that we'll keep trending lower, even though I was looking for the momentum to kind of go back to positive, and maybe take another retest of that 200-day moving average before dropping lower. And certainly we can. I mean, these lines we draw on the charts they're not magic. It's not like, well, because we're below the purple line, the market has to go down further now. That's unfortunately not the way it works. If it was, I'd be a much richer man. Um, so anyway, we'll see what happens from here, but that's definitely some bearish behavior there, highlighted by that red circle, and the drop below the purple line, which is the upward sloping trend line. So I think the next stop is probably down towards that 373 level. And if it doesn't hold there, then we'll probably keep falling. So
I
we'll see
I
what
agree.
happens.
And I think the big issue is, we look at the chart and that helps us measure risk and understand what the trend is. But the CPI print, at least what I took away from it was the they have no reason whatsoever to slow down rate hikes. Clearly, inflation's still there and they're going to keep at it. And that is not a positive environment for stocks. Was there anything else that you took away?
Well, we covered the 14 points from the Jackson Hole speech recently. So I don't think anything's changed basically since there. I think they're unconditionally going to tighten. And I think unconditionally just means it doesn't really matter what happens in stock and bond markets. They're not gonna back off just because stocks go down. You had Neil Kashkari from Minnesota, who I don't typically have a lot of respect for, came out and say he was happy about the market's reaction to Powell's speech. So between now and our next video, we will get the decision from the Fed next Wednesday on how much they're going to hike rates by. So that's next Wednesday, the 21st. We'll be doing our next call on the 22nd. And so we'll have something to talk about there. But for right now, the market expects them to hike by another 75 basis points. I think it could easily be 100 basis points. I think it should be. I think they should go much more aggressively, and I think the market deserves to be materially lower than where it is. So, you know, whether any of that happens or not is to be seen. But that's what I think. And so they're at the neutral rate right now. They're not even restricting the economy. Like the neutral rate by definition is neither restrictive nor accommodative. So they're not restricting. And all the way up until a month ago, they were accommodative. So, I was thinking about it earlier, like if you know that inflation is the highest it's been in 40 years and you think you know where the neutral rate is, where you're neither helping nor hurting the economic situation, why wouldn't you just go right to that immediately? What's the point of going 25 basis points and 50 basis points? And like, it doesn't make any sense to me. It's like, okay, so we're just being slightly less accommodative. Okay, we're just being slightly less accommodative, but you're not even to neutral, let alone restrictive. So why not just do it all at once? I mean, by definition, it's not going to restrict economic growth by getting to neutral immediately. So why not just do it? But anyway, I don't know. They don't listen to me. I don't have the credentials to be a Fed governor. So
Maybe one day.
Yeah.
But yeah, so it's interesting environment out there. And NASDAQ, nothing really to add here. So kind of that same thing. It broke that trend line. These are more interest rate sensitive stocks. And I like this level down here. And it's interesting. People often they ask, well, aren't you supposed to buy on down days? And yes, that's true. But in a bear market, you need like real levels. I want to see selling down to here before I even think about buying, real levels. So weekly, monthly, but
people are insane. You don't buy on big down days. That's the dumbest thing I've ever heard. In fact, especially during bear markets, like that's just silly talk. I mean, the last time if you go to the next slide, maybe we can see a little bit closer. But the last time that the Qs had a 5% down day was on May 5th. So it's like right in the middle of that channel. It's like that biggest red candle in the middle of that channel, like right under, I don't know, Kyle, if you could put your mouse over like May 5th, it's that first red candle. Nope, you're in June. There you go, that one. That was the last time and only other time of this bear market that the Qs was down 5%. Look what happened over the subsequent days.
Yeah, you got your hopes up and then absolutely.
No, even before that. Look at the day after. So May 5th, and then the day after, and then the day after, and then the day after, and then the day after. That thing dropped by 10 full percent over the subsequent 10 trading days after it had its big 5% down day. So if you bought, even if you bought at the lows on that big minus 5% day, over the next 10 days, you were down 10% from that purchase. So buying dips is not a good bear market strategy. It's just not. Selling rips is one thing, right? Selling the up days, selling the big up days during a bear market, that's a better strategy than buying on big down days, because in bear markets, big down days tend to be followed by more down days. That's just how it works. If you look at the current situation, go look at Tuesday. See that chart, see that red candle for Tuesday? That was a minus 5% day, and here we are 2 days later, lower than that. So you don't and look at the giant red candle, like I don't know what, a week ago, that went through year 2020. Yeah. Look what happened after that big down day. I mean, so people I don't know where they come up with this stuff. I mean, I know people who do that, wealthy people too. They're like, well, when the market's down big, I just put more money to work. And I'm like, I hope you go to sleep right after that for about 5 years, because my goodness, that just looks awful.
Yeah,
And it's just not a good strategy for making money in bear markets. It's not a good trading strategy. It's, it may be an okay long-term investing strategy if you are just never going to look at the account again, or like Ken, our partner Ken likes to say, if you're Rip Van Winkle and you're just going to go to sleep for 40 years, maybe that'll work out for you. But you could do much better. You don't buy on big down days. You buy when the market starts to turn and trend higher. So I think it's madness to buy on big down days in a bear market. Selling on big up days in a bear market, much better strategy.
yeah.
So I don't know.
And I think the big thing there is it all falls under the buy low, sell high idea. And that holds true, but you just got to measure where that is. And like you're saying, in a bear market, trends down, wait for it to start actually showing positive signs. So,
Yeah, and even dude, even me, I even hate that. I even hate that idiom. I like, it doesn't make any sense to me. Buy low, sell high. Stop it. Buy high, sell higher.
yep,
Sell low, buy lower. Like that. You follow the trend. Follow the trend. Don't fight the trend. Don't fight the Fed. Don't try and be a hero. Just get the meat of the move and then move on. But
yep.
yeah, man, trying to pick bottoms will give you smelly fingers. That's all you'll get.
Yep. And now here's a fun one. So picking bottoms, right? Crude oil. So we had this resistance here, which then became support. And it looks like oil broke through that, tried to reclaim it, and today is not over yet, but this candle's not looking so good. And I'm not an oil expert. I just read charts. When I see this chart, I see this is the next attractive buying opportunity, and that's 27% lower. What are your thoughts there?
Yeah. Yeah, we'll see if we'll see if it breaks down from here. I don't think that's, like you were just saying, day's not over, and I don't think that's a sure thing. Oil could rally 5% between now and the end of the day and close, on the highs well above that support line. It could even break through that purple trend line. It could close over 90 today. All it takes is the right headline out of OPEC or Iran or somewhere else, and that thing could turn around. In fact, it's already up 1% off of its lows today. It's still down 3.47% as I'm speaking, but looks like it's ticking higher in the intraday, and there's no telling where it'll finish. Even if it closes just a little below that red line, isn't a sure thing that we're going to continue breaking down. In fact, I see down at the bottom, I see a faint green bit on the MACD, which means momentum is actually, ticking back higher. So I think we'll have to wait till next week to see, but certainly those are the levels. I mean, there's not much of a level. You can maybe put in another level at like 65 or something at the bottom of that wick from right around the year end. Yeah, that one in the middle there. But
Yep.
yeah, right there. Like you could arguably put a level there, but the main one is that 62.41. And what I think is notable about that is that it's above 60, which is where the oil producers probably need oil to be in order to be profitable. So I mean, that would be a drop of like 50% from the highs, but we were all the way up at 128, 129, 130, call it.
hmm
And a drop to 60 is like slightly more than a 50% drop from the highs, and the oil companies will still be profitable at that level. So, uh, yeah, I think crude could absolutely drop down to that 62.41. No reason it can't. Whether it will, I think remains to be seen. But even if it does, the oil producers are probably still going to be profitable. So just because oil looks pretty bearish under its 200 day, under the trend line, like just not looking awesome. Although I would say this, the 200 day is still trending higher, right? That blue line there is still trending a little higher, even though the price is below it and price seems to be falling. I think it could work this off and just kind of rebound. So thankfully I don't trade crude oil, but I don't think this is a good reason to go sell your energy positions or your oil producers.
Yep. And that brings us to the next chart here. So this is the XLE. It's the energy ETF. And You've got the 50, it's above the 200. That all looks good. And if we didn't look at oil before flipping to this chart, I think you and I both agreed it looks a little more constructive. But it's still, if I had new money to work right now, I bet, or I would say this is a coin flip. I might like it down here. It's just hard to call right here.
Yeah, I think it's a good time to be selling covered calls against your energy position. Probably not, maybe taking a little bit of profits off the table if you wanted to in an energy position. So, that might work. I see at the bottom, I've kind of highlighted where the MACD is starting to curl up. No guarantee that it will, right? Price has to continue climbing in order for that to continue curling up. It could just as easily break down and go more red, more negative as price breaks down, out of that wedge. So, long term though, we're definitely in a long term bull market for this for oil and energy stocks. It's up 45% for the year right now. Was up 68% for the year on June 8th. So, and even at the recent lows on July 14th, XLE was still up 18% at that point. So compared to what the market's doing, that's a good place to go looking for long ideas. And yeah, if I didn't know what the oil chart looked like, I would bet that this is going to break out and break higher, maybe go retest those all-time or those highs of the year. But given what crude oil is doing, crude oil is going to have a drag effect on XLE if it breaks lower. So have to keep your eye on both of those things.
Yep. And I think you just mentioned it, but covered calls, what's so nice about those is that you don't necessarily have to pick a direction. You're just betting that it doesn't go that direction. So selling up here, you're just placing a bet essentially to say, I don't think it's going to reach that level. I hope not. And that's where you sell those calls at. So it's a nice strategy. And maybe we can talk
By
about
a
that.
certain time.
Yep. By a
And
certain
by a
time.
certain time too. So you're not saying it's never going to go above that level, whatever the level is you pick. So if you sold covered calls at 90 here, you're not saying it's never going to go above 90. You're saying it's not going to go above 90 by the date your calls expire.
Exactly.
And you don't have to hold them till maturity. So if you sell covered calls for $1, at 90, if you get called out at 90, you're selling your shares for $90 a share, plus you're keeping the $1. So your effective selling price is 91. But if the covered call, if XLE drops between now and your expiration date by any amount, you would be able to buy those covered calls back for say 50 cents. And so you don't have to just hold to maturity and see what happens. If you sell something for $1 and then you buy it back for 50 cents, well, you're keeping the other 50 cents in your pocket. So that's what we usually do when we sell covered calls. We look to close them when we can capture 50% of the premium. If you can capture 50% of the premium before 50% of the time passes, you make a nice annualized yield. So that's what we do.
Yep. So, and the next one here, so Bitcoin, and people might catch on that we skip gold. And why did we skip it, Shane?
Because it's not a thing that we trade. It's a boring long-term chaos hedge, and it looks terrible.
Yep.
Well, yeah, it looks brutal. It looks like it's breaking down and probably going lower. The more Fed raises interest rates, the less appealing gold is. I mean, gold's a great inflation hedge, but even though inflation's high right now, they're combating it by raising rates, which means that if you had a choice between buying a 1-year treasury at 3.5% yield or buying a bar of gold that's just going to cost you money in storage, you're probably going to buy the US Treasury.
Yep.
So gold has lost its bid, and even though I think you can still get away with buying it for the long term and holding onto it as a chaos hedge, it is not something that's worth trading, and it's not a chart worth looking at.
Yep. So, Bitcoin here, this is the first time I've looked at this chart. You highlighted it here. So it came up, hit resistance and failed. I see a bearish chart. I also see MACD rolling over, or the momentum.
Yep.
Anything else you see?
Yeah, I think the last time we ran into this long-term down purple line, right, back in April, I also put a circle around that when it ran into that purple line, also ran into the 200-day moving average. And if you look below, back in April at the MACD, I don't know if you want to move your mouse over that, Kyle, but the momentum back in April was kind of looking similar as it was, as it is now. So those two things go together, leads me to believe that there's probably more downside in store in the short term for Bitcoin. And you can see my 80% drawdown target. That is something we've been watching for, I don't know, ever since Bitcoin started to fall from its highs. So we're almost there. It's not out of the question that we could see that 13,800 if Bitcoin can't hold 17,500 or so, which is the low for the year so far. Then 13,800 is like a chip shot from there.
Yep. So, and then the next one, I got to move our faces here because this is a very bullish chart. So this is the 10-year Treasury, and this is not what I like to see. Unless you have a lot of cash on hand, it's great, you can go buy things. If you want to borrow money right now, this is telling you might want to reconsider. Are you seeing anything here besides just a chart that wants to go parabolic, it seems?
Yeah, we're running into that the highs of the year so far at 3.495. So um maybe we'll get a bit of a double top sort of pullback and a breakdown below the trend line, maybe go back to the 50 or maybe even to the 200-day moving average. I somehow doubt it. With the Fed continuing to raise rates, this should just continue to go higher, and the Fed is letting assets roll off the balance sheet as well, which makes interest rates go higher. I think there's a lot of fundamental reasons that this thing could break right through that 3.495 and just keep heading up. But no guarantees, obviously, in the trading game. It's just that this is the most important interest rate on the planet Earth. There's no more important rate to watch, and the momentum is up. That is a very uniform climb higher. Since about the beginning of August, and that it just it's bad for asset prices. I mean, the price of everything, is going to be determined based on some type of derivative of this interest rate. So this is the most widely watched interest rate in the world. As it goes higher, people increase their discount rate that they're using to value assets. So any asset is worth the present value of the future cash that it will generate, and you have to use an interest rate to discount money that you will receive in the future. The higher the interest rate goes that you're using to discount those future cash flows, the lower the current present value of the asset will be. And so this directly reduces the price of stocks and bonds and oil and gold and pretty much everything else. I mean, that's the direct impact, and there's no getting around it. I think it's worse for bonds than it is for stocks. It's worse for tech stocks than it is for oil stocks. So there are pockets of the market that will feel this more immediately and to a greater magnitude than other pockets of the market. But I'll tell you, I would not want to be holding on to long-term bonds. If you still are, I think I said this last week, I'm sorry, you should fire your investment advisor. Now probably isn't the time to bail on all of them, but but there's no telling how high this rate can go, and the higher it goes, the more the bonds that you're holding on to with a very low rate, low yield, they're just going to continue to drop in price. So
Yep.
bonds are not the safe place to hide out. They haven't been a safe place to hide out since interest rates, were close to 0%. How much lower could they have went? That was the time to start unloading bonds and not buy it anymore. At this point, it's a time to start looking at bonds and start putting together a shopping list for what you want to buy when rates finally do top out, which probably won't happen until, end of first quarter of next year. At that point, interest rates will be relatively high, and the Fed might be done hiking rates. Inflation could be going down. That's when you want to buy some bonds.
Yep.
But
So,
not until then. It's
yep.
ugly.
Agreed. And here's the next thing, and these two are tied together. And
Yep.
this is the chart of the dollar, and just still looking really bullish. And part of that is when you raise interest rates, that makes US dollars more attractive because foreign investors can get a little more yield parking money over here. So what you're seeing is pretty strong demand for dollars, and it's not slowing down.
Yep. You got it. So as the rates go up, people need to acquire dollars to lend at that 10-year US Treasury rate, right? Or any other US rate. You can't earn the US yield without investing US dollars. So the demand for dollars goes higher, the value of the dollar goes higher, and the cycle is vicious. The only thing that can slow down the dollar's rise is other central banks around the country or around the world, excuse me, starting to actually raise interest rates in their countries. So the European Central Bank is finally, at a positive interest rate for the first time. Still starts with a zero, but it's positive at least. And as the Fed, potentially begins to slow down the pace of its interest rate hikes early next year, if the ECB is continuing to hike by the same rate they currently are, it could flip, that the pace of hikes in the ECB, the European Central Bank, are actually rising faster than the United States. That would slow the dollar down and put a bid under the euro. Because right now the euro trades at its lowest point since like 2002, and the following year the euro rose by about 18%.
Yep.
So, so that's something to keep an eye out for. And a falling dollar will actually help the stock market. So if it ever gets to that point where the euro is rallying, dollar is falling, that would be a long-term wind in the sails of the U.S. stock market. So we're not quite there yet, but that might be on the horizon.
Yep. And then the next one, we've talked about this, but just implication with the rising rates is if you're trying to buy a house right now, you're looking at about 6% for a 30-year. That does not help demand for housing.
Yeah, and if you're trying to sell a house, you're probably having to drop the price that you're getting for it because people can't afford the interest on the mortgage at 6% like they could when it was 2%. So this has the direct impact or implication of reducing home prices. I heard from one of our real estate agent clients. He was like, "Man, I could tell you all about that. The real estate market is dropping hard. The only places where it's not dropping really, really hard are the ultra wealthy people who are buying and selling 10 and $15 million properties up in Vail, Colorado. Those haven't been hit quite as hard, but the rest of us who don't live in those kinds of homes are seeing the prices come down. The problem is though, is it's not saving you any money on your monthly mortgage because interest rates are going up so much that even though you might be paying a little less for the home, your monthly cash outlay is still basically the same, if not a little higher. So yeah, I don't, housing prices probably aren't going to crash to zero. I don't think we're going to have a crisis where most of the country can't pay their loans back and that they're underwater. But the higher rates go, the lower home prices are going to be.
Yep. So, this next chart too. So this is just a reminder we always flash out there, but in a bear market on the S&P, this is '08, and it was not surprising there to see, rallies of 14, 9, 20, 26%, all while dropping 57%. So just a reminder to people that when these rallies happen, and there can be some really sharp rallies, doesn't necessarily mean it's over.
Yeah, I if you haven't read my market commentary, which came out yesterday, you should check it out. One of the quotes I put in there was from an analyst over at Stansberry Research. He said, "You don't sit back, sip an iced tea on a summer day, and fondly reflect on that time when the NASDAQ rallied 43% in April and May of 2021, including a 9% jump in one day. What you remember is the 78% loss in the benchmark S&P 500 from the dot-com bubble peak in March of 2000 to its ultimate bottom in October of 2022. So the Nasdaq rallied 43% during a bear market, and it was still a bear market. So pretty interesting. Puts it in perspective.
Yep. And then Shane, I'm not quite sure this chart you had put up here. What are we looking at?
This is the Manheim used vehicle value index. So what you can see there is that used vehicle prices peaked at the beginning of 2022. Just actually, I think it's probably December, maybe November of 2021, kind of when the Nasdaq peaked and the bubble and everything kind of started to pop. So used car prices have actually been falling all year, which is one minor blessing in this inflationary world. So I mean, they're still abnormally high. So that hasn't changed, but the peak the peak seems to be in for used car prices, and as those continue to fall, they should help bring down CPI over time.
Yep.
So if you were looking to sell a used car, you know, January would have been a good time to capitalize on that. If you're looking to buy a used car, it's probably still not a good time, but you'd be getting a better price than you would have in January. It's funny, I leased a car, and the car that I leased is worth more than what I bought it for, brand new. Back in what, I guess 2019, November of 2019. I'm getting ready to have to turn it in, and I hate all the deals so much that I'm probably just going to buy it at the predetermined buyout price and hang on to it for a while. So yeah, it's a weird situation where, I drove that new car right off the lot and it appreciated instead of depreciated. Totally abnormal.
Yeah,
May
it's
never happen again.
something else.
Yeah.
And then Shane, you pulled up, people always like to talk about the election and whoever's in office. That's going to impact the return, but what are you picking up from this chart?
Yeah, I mean, year three starts September 30th. So we're 15 days from the beginning of year three. So the way that this chart is measured is from October 1st to September 30th each year of a presidential cycle. And so we are currently in year two, which is the worst year for that cycle. And then year three is coming starting October 1. So maybe this is one small reason to consider being bullish, is that we're heading into the best season of the year for stocks. I guess I don't know if that technically probably starts in November, not October, because some pretty bad things have happened in October. It's the spooky month. Because yeah, the big crash, what, Black Monday or whatever it was October 89,
Eight-
was it?
87, I think.
87, yeah, 87. So anyway, yeah, this is what we're looking at. And I mean, that's a pretty big uh blue bar chart there. I mean, it's materially different than all of the other ones, right? So
Yep.
the single year led to a typical return of 19.8% versus 7.9% on average each year for the S&P 500 since 1950. So if you're looking for a reason to get long, this would be a pretty decent reason. You know, at least one mark in the bullish column against a lot of bearish reasons to be bearish.
Yep. And then, I brought this up, just was reading this in the Wall Street Journal, but something people may not know as much as when you have a rising rate environment and you put money in your bank account, you might start looking around and go, hey, I'm not really getting paid here. Where else could I put that money? So then you take that money, you open a brokerage account, you go somewhere else, and now you're getting 2% instead of, say 0.5%. Well, the implication there is that that bank has a lot less money to loan against and give mortgages out. So what you start to see are mortgages get a little more expensive. That does not help the overall mortgage industry. It also hits other areas in terms of just broad financing. So this is starting to show through a little bit. It's called, deposit runoff. And it's where you could start to see a little less money sloshing around the markets out there to borrow. And that does not help demand. Lower demand equals lower prices. So just something for people to be
Hmm.
aware of.
Yeah, very cool.
All right, Shane, what do you got here?
It's just the CPI. So on the top, you've got the year over year inflation, all items inflation change. You can see we're backing off the peak of 9.1% from a couple of months ago. August came in at 8.31, which, if you want to put your mouse over the bottom area there, 8.3 is the actual, not at the bottom. Sorry. Yeah, there you go.
Yeah.
Actual 8.3 versus the prior month, which was 8.5, but the consensus expectation was for 8.1. So even though it came in a little bit lower than the previous month, it still came in above expectations for the month, which is why you saw the massive drop on Tuesday. Even though stocks haven't continued to fall from Tuesday, uh, at least not too much. We're actually seeing a pretty nice little rally in the S&P as we're talking here today. The nominal level of over 8% is just so high that it is crushing people. The people who can least afford to have this kind of inflation. You know, the people who make the least amount of money are now spending almost all of what they bring home on food, on housing, and on energy, gas, whatever it is, utilities, and they don't have any money left over to go do anything fun. So like, you know, they're not going shopping at Gap. They're not going to go buy a few extra outfits. They're going to buy clothes that they need. They're going to buy only things that they need for the most part, and there just isn't a lot of discretionary spending going on, which amazes me that the discretionary stock index, XLY is the ticker symbol for that sector. It amazes me that that's not down more, and I just kind of wonder what was going to happen when they start to report third quarter earnings in October. And I certainly wonder what the holiday shopping season will look like if this inflation number doesn't come down materially by then. And I'm here to tell you, it probably won't. The
Yep.
Fed can't raise rates fast enough to bring this down by Christmas. And people are going to have to go, you know, Christmas shopping and holiday shopping. And I mean, how much is a turkey going to cost this year? You know, I bet you that's led to at least some acceleration of the holiday shopping season. Like I bet some people are literally already looking to buy Christmas presents because if you wait 2 months from now, they're just going to be that much more expensive given what inflation's doing and given the increased demand that comes with holiday season. So like it might actually be kind of an interesting thing where, you know, some of that discretionary spending gets pulled forward into the third quarter, which normally happens in fourth quarter. But overall, I think it's not going to be a good situation. So this is what CPI looks like. It's got a long ways to go uh, before we get back to 2%.
Yep. And
And this
then,
is the monthly. So at the
yep.
top, you've got the monthly change. You remember everybody was very excited that in July, inflation didn't go up. It was 0.0%. Well, looks like we might be re-accelerating from here. So um, that might be a very bad thing. And then the bottom chart is the blue line you see is the all items index, and then the purple line is the CPI excluding food and energy. So that's the real big problem is that, you know, even though the all items index fell from, you know, 8.5% last month to 8.3% this month, um, if you take food and energy out of the equation, and energy was down a lot, um, you know, the core number, the all items less food and energy actually ticked up meaningfully. So um, yeah, not a good situation. The all items less food and energy or the core CPI is what the Fed tends to focus on a little bit more than the all items. So at any rate, it's still over 6%, and that's a long way from 2%.
Yep. And then Shane, you found some good news again from the Babylon Bee.
Yeah.
You know, I got a good laugh out of this one because, you know, government right now is just doing everything possible, of course, to help us, right? Right. That's the joke.
It's good for a chuckle. I'm not a Republican, so I hate them. I hate Republicans just as much as I hate Democrats for the most part. But I just thought it's funny. So you could just put politicians
Yep.
in where it says Democrats and say politicians propose another Inflation Reduction Act to combat inflation created by the first Inflation Reduction Act, which of course prints a whole bunch of money that we don't have, which means borrowing, and then pumps it into the economy. The more dollars you have, the less each one is worth. So there you have it. The Inflation Reduction Act is one of the most ridiculously misnamed acts that has probably ever been passed in the history of our country. What a joke.
You
What a
bet.
joke.
So, you know, again, Democrats or Republicans, I think just government in general, really good about, you know, not balancing a budget, trying to throw money at anything they can. And right now it's not really helping out. So, well, Shane, once again, it's been a pleasure. We'll see what next week brings, that Fed meeting. I think it's going to definitely have some fireworks. My prediction's lower, but you never know in markets. It's all about managing risk. So hope you enjoy the rest of your day.
All right, man. Later, Kyle. Thanks.
Yeah, see ya.